Mike, the show this morning. It is 6:34 as we get the Real Investment Show underway. Michael Lebowitz, CFA, co-portfolio manager, joining me this morning. Mike, how are you, sir?
I'm doing great. Thanks for having me on, Lance.
Sure. You know, from your lair up there in D.C. where the big impeachment trial is going on, I'm sure you've been watching it with intent interest.
In fact, I haven't seen a second of it yet. I'm done. I am done with politics.
You know, you really can't, with all the nonsense going on, you really just can't blame it.
Right.
Anyway.
I just hide in my bunker and pretend it's not going on.
Exactly. All right, let's talk a couple of things going on. Yesterday, Donald Trump in Davos coming out and making an interesting comment. He said that if the Federal Reserve had not raised interest rates and had just, not tried to tighten their balance sheet, that the GDP would be growing at 4% and that, the Dow would be 10,000 points higher. It's an interesting comment because if you take a look back to 2000, right, the turn of the century, the average growth rate of GDP has been about 2%. We've not seen 4% economic growth. And, that's kind of just the problem of the debt. It's also the problem of the deficit. It's the problem of demographics. It's, a lot of things are leading. And, of course, just maintaining low interest rates have led us there. And, I found it an interesting comment because since 2009, the Federal Reserve had zero interest rates. They were they quadrupled the size of their balance sheet. And yet the best they were able to achieve is about 2% growth every year. So it's an interesting statement from President Trump that the very small bit of tightening they did wrecked the ability of the economy to grow at 4%. And if we just hadn't done that small bit of interest rate hike or small bit of tightening, that, we'd have this massive growth in the economy. But yet there's no evidence when we were at zero and massively expanding the balance sheet that you were going to get 4% growth.
First of all, we're at our limits as far as rates go. So rates can be lowered. They can be lowered to negative rates. But as we're finding, the marginal benefit is so minimal of lower and lower rates. And if you want evidence, go look in Europe, where rates are negative, where companies can even borrow at negative rates, where in a few rare instances, mortgages are negative rates. And it's not pushing up growth in those areas. So the benefit of lower rates is very marginal at best. It does help companies stay in business. So maybe it keeps growth where it's at today, maybe slightly higher, but it's certainly not going to be a boom to the economy. And as far as QE, what's that done for GDP? There's zero correlation between GDP and QE. Again, what QE does is it allows companies to stay in business. It basically buys U.S. Treasury bonds that the Fed can't sell, that they could sell, but at higher rates.
Right.
So there are no true, maybe on the margin, slight benefits, but I'm not sure where he comes at it with that statement.
But this is kind of the general mentality of the entire economic complex, which is, right. If you take a look at the Federal Reserve itself, economic practitioners, the Treasury Secretary, Steve Mnuchin, blah, blah, they all believe that, low interest rates and more QE is the kind of solving the ills, and they're looking at it from kind of a very myopic standpoint, which is simply looking at the stock market as a reflection that is economic growth. But in reality, there's a huge distortion between the financial markets and the economy itself.
Right. If you talk to, and this has nothing to do with Trump, this has to do with prior presidents, with the Senate, the House, the Fed, even economists on Wall Street, and a lot of investors. They think the Fed has a steering wheel and a gas pedal with interest rates and QE, and that this is the economic car that they're driving, and they decide when it's going to go up and down based on what they do with the steering wheel and gas pedal, and they're wrong. They're wrong, and there's statistically no evidence to show that they're having that big of an effect on anything other than the stock market, which hasn't been helping GDP.
And again, it doesn't help a vast majority of Americans. There was a great chart out yesterday. 84% of the population has no participation in the stock market, which was a pretty stunning statistic. But, if we're talking about the economic good as a whole, when 84% of the population doesn't really participate in the stock market, you've got a very small percentage benefit that's actually occurring for the global economy. And the people that are benefiting from it are people that really don't need the economic boost anyway.
Well, on Lance, of the 16% that do benefit, how much of that is solely in 401k or IRA plans that they're not going to see that money for 5, 10, or 20 years? So, yeah, they have wealth, but it's untappable wealth, and they're not going to be able to get at it for a while, and who knows where stock levels will be when they are in retirement age and able to draw down that money.
Right. Well, I guess, and so, one of the things that, and that I kind of want to touch on here too, is that Donald Trump was talking about yesterday about a middle class tax cut, right? So going back to 2017, very late 2017, December, we passed corporate tax cuts, which lowered the corporate tax rate from 35% to 20%, and we had this kind of big surge in the stock market for about 3 months before it kind of all started going sideways. But the question is now is that we can hopefully pass this tax cut for individuals. It's interesting. Good chart out this morning that we posted up on Twitter showing the number of people that have actually, kind of benefited from, from tax cuts and how many Americans are living literally just paycheck to paycheck, just trying to make ends meet.
Right.
The idea of more tax cuts, and again, this is kind of goes back to Reagan, the Trump administration is trying to run the Reagan program, which was tax cuts and these other programs to help stimulate economic growth. However, if you go back and look at the Reagan administration, there was very short-term benefits to tax cuts, but there were longer-term negative ramifications to tax cuts because of the reduced revenue that came into the government.
Right. I mean, that's the deficit we're living with today. And the idea of tax cuts, as much as I like tax cuts, and if we could balance our budget, I would seriously think that's a great idea. But that's not where we're at. We're borrowing over $1 trillion a year. And now we're saying we want to borrow even more a year. And we can't, there aren't investors to borrow that money, right? The Fed has to print money to buy the Treasury debt. We've been talking about that over the last few weeks.
Yep.
So we're just creeping along to MMT.
Right.
That's what this really is all about.
Yeah. Well, look, I mean, this is that's such an easy solution to, right? We just print debt to pay for the things that we want to pay for, and we don't worry about it. It's interesting because, I had Congressman Kevin Brady on this show, and we were interviewing him at the time we were passing the tax cuts. And I asked him the question specifically. I said, this is great. We're going to pass corporate tax cuts, but tax cuts are going to have no real benefit if we don't curtail spending. And he says, no, absolutely. We're going to cut spending. We're going to start, reducing government spending. And so that way tax cuts will really have the best benefit. And he's right. If you actually do cut spending, then you can have reduced revenue, and these things can actually inure to the benefit of economic growth. But the problem was we never cut any spending. It got worse. And to your point, we just passed a $1.4 trillion spending bill. There's actually seems to be no incentive whatsoever anywhere in government at this point to actually curtail spending. You and I recently did a video, which is on our website at realinvestmentadvice.com. If you click on our YouTube channel, there's our macro outlook for 2020. Mike and I spent about 20 minutes talking about these things. There's a very interesting chart in that video showing foreign net buyers of U.S. Treasuries versus domestic buyers. What did we learn from that chart, Mike?
Basically, in the past, foreign buyers, and this is mainly central banks or foreign banks and governments and even some pension funds abroad, were buying a quarter to a third of our U.S. Treasury debt, meaning that domestic buyers, that includes you and me, it includes pension funds, insurance companies, investors, a whole host of different types of investors, only had to buy roughly 3/4 to 2/3 of whatever the Treasury was issuing. So now we sit here today and the Treasury has ramped up issuance to well over $1 trillion a year, which is double that which we saw after the recession. The recession was kind of running in that 300 to 600 billion range. Now we're running in a $1 to $1.4 trillion range. And it's all on the backs of domestic buyers. So it's the onus of all that new debt is more than it appears. And the onus is a lot on its own, just going from 1.3 from, call it, 600 billion.
Right.
So there's an additional 700 billion, of which none of that is being supported by foreign governments or foreign central banks, et cetera.
We'll be right back after the break. More with Michael Lebowitz right here on the Real Investment Show, and talking about this tax cut for middle-class Americans. What's the probability of that happening? We'll talk about that when we come back from the break. Don't go away.
Gina works a diner all day, working for her man. She brings home her pay for love.
Michael Lebowitz, CFA, joining me this morning, and we were talking a little bit before the break about Trump's comments that, if the Fed would just cooperate and just lower rates to zero and start expanding their balance sheet some more, which they are doing, we'd have stronger economic growth. What was interesting, one of the interesting aspects that he brought up was really twofold. He actually made a comment that, had there not been these, like hurricanes and other stuff, that economic growth would actually be better. But it was actually the hurricanes, the national fires, and the fires that we had out in California that actually contributed to economic growth, because it took billions of dollars worth of government spending to help, turn those events around and, provide for rebuilding and construction and these type of things. So, actually those natural disasters actually benefited economic growth. We saw a big surge in government spending. And in fact, if we take a look at economic growth over the course of the last really 24 months, it can almost be entirely contributed back to the surge in government spending within the economy. So, it's again, so going back to this idea of running $1 trillion deficit, that money's got to go somewhere, and it filters into, the economy eventually. But again, that's we're recycling taxpayer dollars. Go ahead, Mike.
Yeah. And there's a really sad part to the whole story, that all these things the government and the Fed do to spur growth, and sometimes they do get a little growth out of it, but it's temporary growth, transitory growth, but they're hurting the long run growth of the economy.
Right.
So you maybe whatever the Fed and the president will do can boost growth to 4% for the next year or two, win him election. But then for the 2020, the majority of the 2020s, instead of a 2% average growth rate, maybe our average growth rate will be 1.5% or 1%. Yeah. I mean, there's a reason the economy has been downward trending for the last 30 or 40 years. And that's more and more stimulus, which has proven to be unproductive.
Right. Well, and let me explain that a little bit better, because this is what's called pulling forward future growth. And what Mike is alluding to is saying simply this, is that if I gave you $1,000 today, you would go spend it on something today. Now, if you didn't have that $1,000, you wouldn't spend it today. You would have to save up for it. Maybe you would buy a new car next year, right? But if I give you money today, you'll go ahead and buy the new car today. Well, what that does is when you pull forward future growth, then that leaves a void in the future that you have to fill. And if you don't fill it, well, you're going to wind up with a lot lower rate of economic growth. And to Mike's point, this is what we've been doing for the last 30 years. We keep running these deficits. They're larger. We keep using deficits and lower interest rates to pull forward this future growth. But every time we do that, we leave a void in the future that we have to fill that hole, plus add some more to it. And that's why you can't get accelerated rates of economic growth. We can't get to 4% growth because we have this massive hole that we have to keep filling in just to maintain economic growth.
And there's a key word there, growth. So economists measure the economy in percentage terms in growth. How much did it change from the year, the month, the quarter prior? It's not an absolute number. So if we go back and look at the corporate tax cuts, they boosted earnings. But it was a one-time boost to earnings. Earnings growth has been flat for 2019. Actually, I think it's slightly lower because earnings got boosted, but then there's no more means for growth. The growth came from the corporate tax cuts. Right. It's the same thing with the economy. That, if Jerome Powell got in his helicopter and dropped $100 bills all over the country, there would be the economy would go gangbusters, but it would go gangbusters for that quarter. Everyone would spend their money, but then what? So you raise the economy from a $21 trillion economy to a $25 trillion economy as all that money is spent. But what's going to happen next quarter? It's going to fall right back to 21 trillion because that money can't be spent anymore. It's been spent.
Right, and this is also kind of the fallacy of MMT and everything else is that, well, we'll provide for this one-time benefit, and but the issue is let's say that we do something like they've been talking, a lot of the Democrats have talked about this universal basic income, right? Let's just give everybody $1,000, right? We're going to make everybody's life easier because we're going to give everybody $1,000 a month. Right? So great. We give everybody $1,000 a month. So when they do that, that sounds great on the surface, except the entire economy moves up to that $1,000. Now everybody's living the same lifestyle they were before, and without another $1,000, they're increasing it to $2,000. Your economic growth rate goes back to zero because the economy adjusts for whatever level of income you get. So while the intent sounds great and it may provide a very short-term benefit for individuals, the economy is going to adjust and completely wipe out that entire benefit that you got up front.
Right. That's exactly right. And why does growth matter? It matters because we have an economy predicated on debt. And growth rates have to match interest rates or we have a problem.
Right. And again, this is the one thing but this is the thing that nobody wants to deal with. Trump made a very interesting comment yesterday from Davos. He was asked about Social Security. Because when he was being elected, he said he wouldn't touch Social Security, and he made a comment yesterday that hey, we could look at doing something with Social Security. And there's lots of comments that Social Security is underfunded. We need to potentially look at changing some of the rules, maybe extending the retirement age, maybe doing some means testing. I mean, there's some problems with Social Security that do need to be addressed. We don't have, we have about 2 people paying into the system for every person taking out. It's just not supportable long term. And we all know these issues. But of course, immediately the lashback is don't take my Social Security away. The problem with debt is that we're so far into it that nobody wants to take the pain to get out of debt. And if you really want growth, long-term economic growth of 4 or 5 or 6% and create economic prosperity for the majority of Americans, you've got to deal with the debt. But nobody wants to do that because it's painful.
Right. The problem is someone benefits from every dollar of debt, whether it's a defense contractor, whether it's someone receiving food stamps, whether it's a Social Security recipient, you name it. Someone is receiving that money and someone is lobbying either directly or on behalf of the people receiving that money. And no politician, and this goes to both sides of the aisle, want to touch that. And they haven't touched it in years. Right,
because it's a surefire way to get you unelected is why.
Right.
When you start talking, maybe the millennial voters don't care about Social Security. If you actually, poll millennials, they don't think they're going to get Social Security anyway. But, for the baby boomer generation, the ones that actually show up to the polls to vote, don't touch my Social Security because I've paid into the system and I'm owed this money. But
and by the way, ARP has a very big lobby.
Yes.
That's what they are. Beyond all the services they provide, my guess is their biggest function is as a lobbyist.
Oh yeah, and they do a very good job of doing it. I know I'm getting older now because I'm now getting AARP membership cards in the mail. So
I am as well, and I rip those things up before I even open them.
I know it just offends me.
I don't care if it's money in there. I'm not taking it.
I know it just offends me that I'm getting those in the mail. So. But anyway, so just kind of wrapping this up here a bit. Of course, Donald Trump is talking about potentially passing a tax cut for the middle class. This is getting some immediate media traction, but odds are probably pretty small this really goes anywhere.
Yeah, I don't see how the House would help the president with a tax cut, because that will help the economy for a quarter or two, which would just greatly increase his odds of being elected. That said, the House did pass the spending bill, which will, on the margin, help the economy.
Right, but there was a lot of stuff. The thing is that there was a lot of things embedded in that spending bill that were favorable for the Democrats.
Right.
And of course, it's been interesting because we really haven't heard a whole lot about what was actually in the spending bill. But, when you actually start reading through that thing, there was a lot of pork on that. There was so much pork on that, you couldn't get that pig on an airplane. Let me put it that way.
And the problem with a tax cut is that if he did get a tax cut through, there's going to be a signing, and it's going to be him with the pen and him getting credit, no matter who did the work, Democrats or Republicans. And I just don't think the House, under Pelosi, will allow that to happen, especially in an election year, regardless of what they think of it.
Yeah, I know, and this is going to be a thing. I mean, if they do get it passed, it'll have to be potentially sometime after the election, and that's only assuming that Republicans can win back the House in the fall. So,
I think I disagree. I think after the election, even if the Democrats have the House and even if they have the Senate, I think there's some possibility because you don't have an election anymore. This may be seen by them as something that will help them in the next set of elections.
That's true. That's something they, hey, we helped the president pass a tax plan. It's just, there's so much animosity and so much division between the House and the Senate currently. I think that you could come to the floor with a plan that would provide infrastructure and MMT and everything that pay off college and everything else that the Democrats actually want, and they would reject it just simply to try to defy not helping the president, right? So we've completely moved away from doing what's right for the country, doing what's just beneficial and expedient for political parties, and that's the biggest problem with getting economic growth back.
Political expediency. It's the word of the day, or the 2 words of the day.
2 words. All right. Well, Mike, the markets are going to open up flat this morning, a little bit down. Again, kind of concerns over the coronavirus. I know, right? We're down 3. The market's crashing. Oh, my gosh. Needs more QE right now.
Sell.
Of course, the coronavirus, that's the kind of the big deal. But Mike, thanks for joining us this morning, and we'll see you next week. I'm your host, Lance Roberts. Thanks for joining us today. Get by our website, realinvestmentadvice.com. Our latest blog post is up on the website now, and talking about, yes, interest rates are going to zero. Recent article out in the Wall Street Journal confirming what we wrote 3 years ago. Wall Street Journal finally getting around to it. So that's on the website now. Get by the website, realinvestmentadvice.com. Get our latest blog posts, newsletters, and more. And make sure and subscribe to our YouTube channel and get all of our latest updates, videos. We've got a podcast coming out next week with Seth Levine. Lots of other stuff there as well for you as well. Realinvestmentadvice.com. Have a great afternoon. And so stick around, though, because Chris Salcedo is coming right up.
If I had a little money, it's a rich man.